Hi team, in this video you're going to learn about how an independent sponsor acquires a business. And for the purpose of this video, think of an independent sponsor as a one-man private equity shop. Before we get started, I need to introduce two vocabulary items. Don't fret, not complicated. General partner and limited partner. Think of the general partner as the independent sponsor that's structuring this transaction and getting it closed. They are the group buying the business. And then think of the limited partner as the group of investors coming together to fund the acquisition. If we moved a little bit quickly through that, don't worry, it's all going to be explained with some amazing artistry here momentarily. So let's take a look at this process from the perspective of an independent sponsor. What brings all of the parties together required to close a transaction is the opportunity to create value within a business. And there's a variety of reasons that an independent sponsor could think that they can add value to an entity. It may be that the business is just mismanaged, or that they have the wrong employees in place, or maybe there's too much revenue concentration and this independent sponsor has industry ties that would allow them to diversify away from that. Whatever the reason, the independent sponsor hopefully sees an opportunity to increase cash flow, improve curb appeal, and generate a really strong exit to create returns for all of their limited partners. To get this done, the independent sponsor will form a partnership and then look to raise funds from a limited partner to fund the acquisition. Hopefully, the independent sponsor also has capital to contribute, but it isn't always the case. With the equity raised, the general partner, our independent sponsor, will then form a holdco or holding company to make the acquisition. And then the GP's next task is to approach banks and lenders and providers of credit to see what capital structure they can put together for this particular transaction. And this can be a very demanding process. You might get somewhere between 5 and 12 different term sheets that you have to go through and then try and get these credit partners to work together. Or you can work with a unitranche partner who provides all of the capital required with the exception of the equity. All of these different capital structures have to be modeled so that you know exactly what your risk profile is and measure that against the return profile. And once all of the capital has been raised, then you can use the holdco to acquire the target company. And this is basically where all of the hard work starts. Now the independent sponsor has to hold on to this entity for 3 to 5 years, maybe even longer, 7 to 10 in some cases as long-term capital becomes more attractive, and manage the entity through a successful exit. Anything can go wrong in that time period, and most of the time things do. It can be extremely demanding for anyone. If you think about a private equity fund using a team that sometimes has an operating team within that team that's tasked on any troubled assets, in this situation, you have one individual, maybe a handful of guys that are going out to buy a business. So when something goes wrong, everyone's fully engaged, and that can be incredibly demanding. But hopefully, over the course of the hold period, you start to really create value, and the enterprise value of that entity grows. Since it's unlikely to grow perfectly each year, we will keep it flat in year 4 and then make a great jump in year 5 for a happy conclusion. This plus the repayment of debt over the course of the hold period is generally the objective. Because what remains is the value of the equity, and in this example it has grown substantially. But recall from the original schematic that most of the capital came from the limited partner. So how does the independent sponsor get compensated for this crazy amount of work? So let's explore how an independent sponsor gets compensated. There's basically 3 categories of compensation. 2 of these categories involve fees, and the first really revolves around one-time fees, so a fee for closing the deal or a fee for exiting the transaction, for example. And the second is a management fee. Unlike a private equity fund, which will charge management fees based on AUM, or assets under management, an independent sponsor will generally tie the management fee to earnings. It will be something like the greater of $250,000 a year, or 5% of EBITDA. And generally this involves a cap. So if the business is held for too long or grows too quickly, the independent sponsor isn't getting too much compensation from this one source. And finally, we have the most important category, which is the promote. This is the portion of proceeds, the equity value we were describing, that goes to the independent sponsor. This is commonly known as carried interest, and we use a distribution waterfall to calculate the value of that promote. For a close look at this process, please see the video titled Distribution Waterfall, which is also a part of the LBO video series on asimplemodel.com. So we've just talked about all the parties and how they come together on a transaction. Next, let's talk about the actual structure of the transaction. And this is something that really revolves around tax consequences during the hold period and at exit. And here we're just going to focus on the holding company structure strategy at a superficial level. If the intention is to make distributions during the hold period, it may be wise to select a pass-through entity. Pass-through entities don't pay income taxes at the entity level, Instead, this responsibility is passed on to the shareholders, so profits are only taxed once. With a C corporation, the entity would first pay federal income tax, and then the shareholders would receive taxable dividends. This is known as double taxation. The Tax Cuts and Jobs Act, which introduced a flat 21% federal income tax rate for C corporations beginning in 2018, drastically reduced the discrepancy between these two approaches, so it should definitely be evaluated on a case-by-case basis. If the strategy does not involve distributions, then there is one huge advantage for some C corporations. If the shares qualify for Qualified Small Business Stock Treatment, or QSBS, it may be possible to eliminate tax on all, or at least a large portion, of your gain at exit. We won't get into this further in this video, but I'll provide some relevant links below if this is of interest. Alright team, that's it for the introduction on independent sponsors. If you want, all of the diagrams and notes used as visuals in this video can be downloaded just beneath the video player, so go ahead and click on those. And otherwise, hope it was helpful. That's it for now. Cheers.